I sold out of energy. Now, does this mean I'm bearish on energy? I'm going to answer that question because it's not the case exactly. But I do believe in the future of energy, especially oil and gas. So why did I sell? First of all, I do want to talk about the investment I sold, and it is an ETF, and its ticker symbol is FENY. This is a Fidelity Energy ETF, and it represents the performance of the energy sector in the US market. And let's talk about this fund, go into some details, and then I'll talk about why I sold and if there's any worry with energy, the energy sector in general, if you should be bullish or bearish yourself. So let's start with the top 10 holdings. This fund, you'll see here, holds great companies, big companies like Exxon Mobil, Chevron, Conoco. We have Phillips 66, Valero, so on and so forth. Of course, a big holding of it is Exxon Mobil. It makes up 22.89% of this fund. So it is a little maybe heavy on the allocation to just the top 2 or 3 companies that might pose some risk. But I'm going to show you why it's actually been a good thing for this fund. And if we look at some more details, we'll see that the net expense ratio is a very small 0.084%. My last video, I talked about how a lot of funds out there that people invest in are over 1%. This is 0.08, so very good there. And it has a decent yield at 2.74%. I will say because I invested in this fund so early, I had over a 5% yield, but I'm going to talk more about that and why I would sell out of something that has that large of a yield on cost versus the yield that the market has right now if you were to buy in now. So let's briefly look at every of the top 10 holdings in this ETF and kind of gives us some more information that I think is very interesting and powerful to know. So of course, Exxon Mobil is its top holding, making up over 22% of this fund, and it's up over 77% over the last 5 years. That is very good performance. And then if we look at the dividend information, it now has a yield of 3.11%, so that is very healthy. It's decent if you're a dividend investor. And the growth has been a little kind of underwhelming. 1-year growth, 4.4% of that dividend, and 5-year growth of 1.77. The payout ratio is 45.45. So for me, that's okay. Anything below 50 is good. And then between 50 and 75, it's okay. Anything above 75 is where I start to worry and need to really look into it to see if dividend cuts are going to happen, things of that nature, or maybe no more growth of that dividend. Next up is Chevron. Over the last 5 years, hasn't done as well. I would say this isn't a great performer. It's up 28.82% over 5 years. So not that great. If we look at its dividend information, it's not as great as Exxon Mobil's. Now its yield is higher at 4.38 as well as its growth. It has a 1-year growth of 7.95 and a 5-year growth of 6.49, but that payout ratio is much higher at a 64.55%. So they're paying out these dividends to investors, and it's taking more money away from the company and giving it to us than Exxon Mobil, where they get to keep more of their profits because their payout ratio is much lower. So I would say that this kind of starts to get into that realm of maybe you can expect future growth to be slower of that dividend. But again, it's been good over the last 5 years, over the last 1 year. But I think they're going to want to get control of that and kind of lower that. So my expectations are due to the stock performance. Maybe this is something people are kind of baking into it because it is a good investment if you're a dividend investor, right? 4.38% yield. But I don't think they'll be able to sustain that growth. Next up is Conocophillips. Now, over the last 5 years, it's done excellent, up 97.11%. You have almost doubled your money in 5 years. And if we look at its dividend information, it's spectacular. It has a yield of 3.18%. So yes, there's some that are higher than that, but look at this. 1-year growth of your dividend, they grew at 13.73%, and over the 5 years, 13.72%. So they keep it very stable, and the payout ratio is low, 39.20%, which in my opinion means they can continue to grow their dividend at this rate. Next up, we're going to talk about EOG Resources. Now, they have been impressive as well. They're up 89.26% over the last 5 years with their dividend information. It's actually really good. Now their yield is lowered at 2.79%, but look at that growth. You're getting a 10.3% raise over the last year, and over the last 5 years, you get an average of 25.92% raise. This is phenomenal, and the reason why they're able to do this is that payout ratio is extremely low at a 28.11%, so you can expect this growth probably for some time to come in the future, and that's awesome if you're a dividend growth investor. I actually might look into this company a little bit more myself personally. Then we have Marathon Petroleum Corporation. This one is an excellent performer. Look at that, up 156% over the last 5 years. That's amazing. Let alone their dividend information is also impressive. Now, they have the lowest so far yield of a 2.06%, but the growth is healthy at a 1 year of 10%, a 5 year of 9.25%, and that payout ratio is extremely low at a 17.37%. So they definitely have a lot of room to grow this dividend. This is also one that I might look into because that shows that they have pretty good financials. They're controlling things really well. Next up is Schlumberger. I actually held this company for a little while. I ended up selling out of it. It just wasn't performing well, and it looks like it's not been the greatest performer over the last 5 years at 36.11%. And if we look at their dividend information, there's some mix of good and bad here. So their yield's a little low at 2.49. The 1 year growth is 10%, but that 5 year growth is a negative 11.27. So I bet you that's due to a dividend cut. If I had to guess, there could be many reasons why this is. So you'll want to look into this if you're interested in Schlumberger. Their payout ratio is actually good at 35.95, not the lowest, but not the highest we've seen. So they have some room to continue maybe that 10% growth of their dividend annually. Next up is Phillips 66. Now, over the past 5 years, it has not been a great performer. It's only up 26.46%. And if we look at their dividend information, their yield is pretty healthy at a 3.48, and their growth over the last year is 9.52%, so that's good, but the 5 year growth is a little lower at 5.02%. That payout ratio is healthy at a 39.48. It's not low, it's not high. So I think that this company will still be a solid dividend payer and one that you might want to consider. I don't think I will consider this. I'd like to see that payout ratio lower and the growth higher, but it's not bad for that yield. Next up is Williams Companies. This one has done awesome. It's up 114.72% over the last 5 years. That's amazing. As well as their dividend information, it's very interesting. So their yield's pretty good, 3.88%. The growth is not bad. Its 1 year growth is 6.15. Over the last 5 years, it's 4.56. But that payout ratio, yikes, 81.9%. This is one I'd really dive into and see why that payout ratio is so high. You don't know what might be affecting it, so maybe it's something that's a no worry, but maybe it is something that you might want to consider, that they might cut their dividend or stall growth at some point to kind of get things under control. Next up is ONEOK. I'm not sure exactly how to say that, but they've had not that great performance. They're up 36.31% over the last 5 years. Of course, you see that drop when the pandemic hit, as with all energy stocks, most every stock, and then energy's done really well over the last 4 years since that drop. And if you look at their dividend information, not the greatest situation. They have a pretty high yield at 4.23%, but the cost of that comes at a low growth of 3.66 over the last year and 2.15 over the 5 years. And that payout ratio is the highest yet at 86.27%. So again, you really want to look at that if you own this stock or are considering it, because this may be a dividend dud, not a dividend growth company. Then Valero Energy Corporation. So this company's done pretty well. It's up 58.36% over the last 5 years. And if we look at their dividend information, I'd say it's pretty solid, a 3.14% yield. The 1 year growth is 4.90 and the 5 year growth is 3.52. So they're accelerating that growth. That's the other way you can kind of look at things. And the payout ratio is very healthy at a 24.44%. So I would consider this a solid dividend growth investment to consider. So let me say this first. Energy is something I feel we all depend on, and it's going to be that way for a long time to come. It's not just the gas we fill our cars with, it's what millions of plastic products we use are made of. Think of the healthcare system and how dependent they are on plastic. So I don't think renewable energy alternatives are going to make these companies go out of business or even hurt them much, because it's still these oil and gas energy companies that offer reliable energy that can handle large demand that our society needs which will only grow as technology advances. That means they're going to want more and more, or need more and more energy, and that we're going to have to provide it to them somehow, right? And right now, oil and gas, I think, are it's the main player of energy right now. No other energy has truly proven to do what oil and gas does. Now, of course, years to come, 10 years down the road, 20 years down the road, maybe we'll see something a little different. But right now, it's oil and gas that is the main player. Plus, many of these oil and gas companies are transitioning a part of their business to other renewable energy sources. So they're diversifying, they're keeping up with the times, right? They're adapting, they're growing. That's what good businesses do. What I do think will happen is I think these oil and gas giants, their market share will slowly become less and less, but still grow, if that makes sense, right? Just because their market share is shrinking doesn't mean they're growing. It just means the other sources of energy, maybe the other companies other than the ones that we talked about, are just growing faster. And I think this will be due to the fact that any good company or nation, shall we say, so let's take our nation, the United States, for an example, and all these big giant companies, they do not want to put all their eggs in one basket. Diversity is what is going to be sought after from these companies and our nation. It's just what any good company would do. We see large companies still depending on oil and gas heavily, but they are also getting power from solar, wind, and most recently we heard that Microsoft plans on using nuclear energy. I think that's going to be a high growth area in the future. Think of it like this. As a family, would you rather own one car or two cars? Probably two. That way, if one breaks down, you still have another car so that your day won't be completely halted. That is how any good company thinks. So we will see more diversity, usage in the energy space, but oil and gas will still be a large part of that. So I feel growth for energy companies, the ones that we're talking about, the main oil and gas players, they are going to be going up against some more competition in the future. They're not the monopoly they once were. So again, I just see their market share slowly shrinking, but they're still going to grow themselves. It's just other sources of energy and companies are going to maybe grow faster in the next couple decades. So that's one reason why I sold. Also, volatility. When government regulations, start to happen or get talked about, oil and gas reacts like crazy. Same with conflicts that are going on around the world. The pandemic, if another one hits, it's just a very volatile sector. So that's another reason. Also, the government. We have an election coming up, and no matter who wins, they will push for lower energy prices. I think one will push more for it than the other, but that is really going to happen at the pump, right? They want to have consumers see prices go down, and that gives them validation that they're doing good. It's going to make people happy. They'll get votes, so on and so forth. But this means less revenue for these oil and gas giants. And right now, gas prices are high due to inflation and escalating global conflict. So I think that's a reason is we kind of are at the height of it right now, right? They're able to charge more, but going further, there's going to be pressure to lower those prices. The next thing is I barely invested any money into this fund. I literally had $300. And yes, I about doubled my money, so I made about a 92% profit. But with that low amount, it's not going to make a difference for my portfolio if it takes off or not. And it's already took off so much, and I feel kind of we're at that height like I was talking about. Now is the time to sell. That's another reason. Also, another reason is the high expenditures that come with the nature of energy. So much money has to go into all the infrastructure and the upkeep of the different sources of energy and all the components. It's a lot of money. These companies have to put up a lot of capital for that. So I think that's also a risk that these companies face all the time and they're trying to manage. So those are the main reasons why I sold. And also, I feel like I capture energy through other companies. Maybe not directly, but indirectly. So let's take Microsoft, for example. They're going to be using a nuclear plant to get nuclear energy. They also use oil and gas and probably use solar and wind a little bit. So if something happens to one of these energy sectors, let's say mainly the oil and gas sector, it's not going to cripple my investment in Microsoft, as they should have a means to continue on business as usual due to the diverse energy sources they can pull from. Whereas if I invest directly in, let's say, Exxon Mobil, If something happens to the oil and gas industry, I'm SOL, right? So I think it's more indirectly, a way for me to get that exposure because they're using, especially the big tech giants, they're using so much energy. They're almost energy companies in themselves in a way. So the question is, would I buy into energy again? Should you be bullish? Should you be bearish because I sold? I would absolutely buy into energy again. I think it's something that our society needs. We operate off of it. I think if something happens where, the stocks of these energy companies or some of these ETFs like I invested in take a nosedive, I would absolutely get back in because I do think there are some benefits on how reliant we are on energy. So I think it's a game of when you get in, and I got in at a good time. I was able to double my money basically, but I didn't put in enough. So let's look at my portfolio real quick. I'm in the green, 27.95%. Of course, the ETF, the energy ETF, FENY, is missing, but you'll see Microsoft right there. It's up for me 75%. Again, I think I'm getting some energy exposure here. Amazon's another one. They're nearing 70% in the green. I think I have a portfolio that offers some diversity on the different types of energy that are used. But let me know if you have any questions on this portfolio. There's no deep dive into this today. We're talking about energy stocks and me selling out of FENY. So let me know your thoughts on the energy sector and if you invest in it. Warren Buffett loves energy stocks because he knows our world is so dependent on them, and it's done really well for him. That does not take away the volatility, risk, and other items that I mentioned. So I think it's a solid sector to put some money in. I liked the way I did it through an ETF. I think it's much safer. I'd be curious to see what you all are invested in the energy sector, or if you avoid this sector like the plague and why. So thanks for tuning in, and we'll see you next time on Mark Arnold's Finance.